31.06 lakh crore rupees. Yeah, let that sink in for a second. To put that massive number into perspective, that is the total deposit base HDFC Bank had amassed by the end of financial year 2026. It is an absolutely staggering figure, and it perfectly captures the sheer economic gravity of this institution in India. But, managing a balance sheet of this ridiculous magnitude hasn't exactly been a smooth ride lately.
Which brings us to what is easily the most fascinating question in the banking sector right now. How exactly is India's largest private bank navigating the incredibly complex aftermath of its historic mega merger with HDFC Ltd? Because when you smash together a giant mortgage lender and a giant bank, it completely scrambles your fundamental financial metrics. It requires a massive, totally deliberate strategic rebalance.
All right, let's just get right into it. Welcome to this explainer. Today we're decoding HDFC Bank's fundamentals to see exactly how management is executing this epic rebalancing act. If you're a fan of digging into banking metrics, you are in for an absolute treat. Let's open up the balance sheet. Here is our roadmap for today. First, the post-merger reality. Second, the deposit gathering engine. Third, dissecting the loan book. Fourth, margins and asset quality. Fifth, the digital banking moat. And finally, valuation and outlook. Okay, starting off with Section 1, the post-merger reality. So, to really understand the immediate challenge they faced, you have to look at the loan-to-deposit ratio, or LDR. Think of LDR as a bank's liquidity speedometer. It basically measures if your assets and liabilities are matched up. When HDFC Bank absorbed HDFC Ltd, they suddenly took on this mountain of loans, but they didn't get an equally massive pool of customer deposits to go with it. Boom, the LDR spiked, and they had an immediate liquidity gap that absolutely had to be filled. And when we peek at the loan mix, you can see exactly why that happened. Because of the merger, mortgages suddenly swelled to make up roughly 33% of the bank's entire loan book. Just to give you some context, before the merger, home loans were only about 11% of their mix. Jumping from 11 to 33% literally overnight is a monumental structural shift. Now, having a huge, secured, long-term mortgage portfolio, fantastic for stability. But man, it put intense, immediate pressure on them to find the funding to actually support that massive loan book. Moving right along to Section 2, the deposit gathering engine. So how do you get that funding? Well, the absolute holy grail for any bank is the CASA ratio, current and savings accounts. Why? Because banks pay next to nothing in interest on these compared to fixed-term deposits, so it drastically lowers their overall cost of funds. Right after the merger, HDFC's CASA ratio took a hit because they absorbed a ton of expensive term deposits, but they've been fighting tooth and nail to keep it healthy, and it's currently hovering right between 34 and 38%. And honestly, their execution on the ground has been phenomenal. Look at Q4. Total deposits surged 14.4% year over year. But here is the really crucial part. They maintained a retail deposit mix of 82 to 85%. Almost half of their inflows came from granular deposits under 3 crore rupees. This shows management is deliberately and successfully pivoting toward highly sustainable retail funding to organically pull down that high loan-to-deposit ratio. It is textbook deposit management. Let's move to Section 3, dissecting the loan book. Now that we know how they're funding things, let's look at who they're lending to. It's a delicate balancing act right now between two totally different business models. On one hand, you've got retail lending, personal loans, credit cards. These are very granular and offer high yields. On the other hand, corporate lending brings high volume and stability with big conglomerates, but the margins are razor thin. So to offset those lower yielding mortgages they just acquired, HDFC Bank is purposefully prioritizing higher yielding retail and rural loans right now to boost their overall margins. You can see this playing out perfectly when you look at their growth drivers. They're absolute stars. Digital banking is just exploding with 43.5 million active users. HDFC Sky, their broking arm, is seeing massive traction. Get this, gold loans are up an incredible 22% year over year in assets under management, largely driven by rural expansion. And SME lending, up 18%. These high-growth, high-yield segments are the real engines driving the bank's future profitability. Which brings us to Section 4, margins and asset quality.
So they are growing, but are they operating efficiently? To figure that out, we have to look at the net interest margin, or NIM. Simply put, this is the difference between the interest the bank earns on its loans and the interest it pays out on your deposits. When your cost of funds goes up because you're aggressively competing for deposits and you suddenly have a huge chunk of lower-yielding home loans on the books, well, your NIM is naturally going to get squeezed.
And yeah, that's exactly what the data shows. HDFC Bank's core NIM has stabilized right around 3.35%. Now, before the merger, they were regularly cruising with NIMs well over 4%. So while 3.35 is definitely a drop from those glory days, it's actually showing a lot of resilience. As their older deposits reprice and that shift toward high-yield retail lending kicks in, we're seeing the margins stabilize. But guys, here is where HDFC Bank absolutely flexes its muscles, asset quality. Despite digesting a mega merger and pushing for massive loan growth, their gross non-performing assets, the bad loans, are sitting at an incredibly low 1.15 to 1.24%, and their net NPA, a microscopic 0.38%. In the banking universe, this is a staggering display of conservative underwriting. It proves they aren't taking reckless risks just to chase better margins.
Let's look at Section 5, the digital banking moat. You want to know the secret weapon keeping their operating costs in check? It's their sheer digital dominance.
A mind-blowing 93% of all their transactions are now entirely digital. They've got 43.5 million mobile users processing 3.8 billion transactions. That kind of digital scale gives them massive operating leverage. They can process unbelievable volumes of business without having to endlessly build expensive physical branches, keeping their core cost-to-income ratio incredibly lean at roughly 39%.
Finally, Section 6, Valuation and Outlook.
So what does this all mean for the bottom line? Taking a look at the latest institutional data, their overall consolidated profit after tax hit 217.2 billion rupees in Q4. That is a very solid 11% year-over-year growth. So despite all the margin pressures and the higher cost of funds, this combined entity is still an absolute machine, generating massive and growing profits.
And this right here perfectly illustrates the current opportunity the market is weighing. Check out the valuation metrics. The price-to-book multiple is projected at just 1.8 times for FY28. Historically, HDFC Bank has commanded much higher premiums. So the fact that it's trading near 3-year lows, well below its historical average, while still churning out 11% profit growth and keeping asset quality practically perfect, that suggests a very compelling risk-reward setup.
So bringing it all together, what's the big takeaway from this explainer? It's simply this: the strategy is working. Management is successfully pulling off what was always going to be a painful, complicated post-merger integration. They are shrinking the loan-to-deposit ratio with granular deposits. They're successfully rebalancing the loan book for better yields. And through all of this turbulence, their asset quality remains absolutely pristine.
Which leads us with one final, pretty provocative thought to chew on. With the massive merger now mostly digested, operations getting back to normal, and valuations sitting near historic lows, is HDFC Bank's strategic rebalance finally complete? It is a fascinating question, and it is exactly why you should be watching their next quarterly results very closely. Thanks so much for joining me on this deep dive into the numbers.